Sure. So 2022 was another record year. This is the third record in a row. Last year, we surpassed 10.3 billion contracts. First time over 10 billion contracts. In 2023, we're on pace for 11.5 billion contracts. So volume's up about 12%. Last year, volume was up about 5%. Where it's coming from is really interesting because we had a few years after COVID that were very heavy retail in retail getting into options, right? Last year, there was a big shift, right? The market went down. We had a decline for the first time in a while. And retail pulled back, which is not very surprising, but option volume was still higher. And that is coming from two things, really. The institutional activity picking up. Okay, so some of the hedge funds and the firms that kind of sat it out for COVID jumped right back into the market, basically. And then the biggest story is this short-term option trading, the zero DTE flow that you hear about pretty much every day. And that's become a huge part of the market. And that really is driving most of the growth. So the growth is in the index and the ETF space and not so much in single stock, although single stock is kind of holding its own. That's a great question. There's been an evolution, right? We used to have, third Friday expirations, and then we filled in weeklies and started having expirations every Friday. Then Cboe filled in Monday and Wednesdays, specifically in SPX. And then last year we filled in the Tuesday, Thursday, seeing how active the Monday, Wednesdays were. When you talk to people that are trading these, you actually get a lot of different reasons for why they like to trade them, which I think is why we have such a sustained high amount of volume. I mean, in SPX, it's over 1.5 million contracts a day just in the expiring day options, which are not listed on the expiring day. They're listed a month out, right? But so basically there's an expiration every single day for the next month. You hear people saying that they like the precision of the risk management. Basically, if you want to hedge for today, you can buy some puts this morning. You're not hedging for the week, you're not hedging for the month. You're basically making a very specific position adjustment or a bet. There's also a big contingent of retail that likes to trade these contracts. They're coming in for different reasons. There's buyers and there's sellers. There's a lot of premium sellers that tend to do it in put spreads and call spreads, kind of defined risk premium selling. And there's whole kind of, in a way, it reminds me somewhat of the kind of the retail action in 2021, because there's a lot of retail talking about how do you trade these things, what's your strategy, do you enter at 10, do you enter at 10:15, do you always close by 2 o'clock? And because we see all that kind of flow, and then on top of that, we do have institutional activity as well. In some case, I met a guy at a hedge fund conference who said, well, I trade the zero DTs every day. And I said, well, what do you do? He's like, I just use them as delta hedges. He's like, I like the defined risk. If I need to get short, I'll just buy some puts rather than selling some futures, which kind of has a much more kind of an unlimited risk profile. It's like, if I buy puts, I know I'm on the hook for $2 if it goes the wrong way, but that's it. That's also something we had a ton of questions about, right? So what's really interesting is that now that we have expirations every day, we can have a 1-day VIX. We could also have a 2-day VIX and a 5-day VIX and an 8-day VIX if we wanted. We already had the 9-day VIX because the weekly supported that. So the 1-day VIX, it's actually, there are a couple of really interesting things about it. It's minute by minute rather than a daily basis. So it's really actually more like a 405-minute VIX. It's kind of set to be the midpoint of the 405 minutes. So in the morning, it's all today's options, but by the afternoon, it's all tomorrow's options. The beauty in having that as a metric is it's very specific. It's telling you the expectations for how wild the market is gonna behave just for the next 24 hours. The VIX tells you what's going to happen or what's expected to happen over the next 30 days. But this VIX 1 day really is basically translating SPX option prices into the expected standard deviation, how big we're going to see these swings. And it becomes, it's another metric that kind of completes this term structure of basically being able to see the market expectations of how volatile it's going to be for the next 1 day or the next 9 days or the next month. There's actually a VIX all the way out to a 1-year VIX as well. Yes, I mean, we're already almost there. In SPX basically has, I think there's only 4 hours a day that SPX options are closed now, right? Because we have an overnight session and we have an aftermarket session for a half an hour. The overnight, I've talked to some participants about, would we ever get to 24-hour trading for options in general? And the answer is usually like, well, that would be pretty ugly because the stocks, some stock, even if you trade a stock overnight, right? I think there's a couple of venues where people technically can. There's not enough liquidity to kind of support the derivatives. So I think we'll get there eventually, especially as you get more international participation, just kind of as the world marches forward. But for the short term, index products, that's where all the liquidity is, and that liquidity is 24/7 basically, right? So it works really well for kind of round the clock trading for indexes. And I mean, as you've been in the business long enough. Stocks have a lot of funky things that happen every once in a while, right? You get crises, you get scandals. Indexes behave a little bit more as you'd expect with the realized distribution of returns. Sure. So this quarter, after actually having a pretty strong rally for the first couple months, we hit this little mini banking crisis, right, with Silicon Valley Bank imploding, and things happened very, very quickly, right? And so then there was this fear of contagion across the industry, and you have other banks getting sucked into it. In a way, especially for those first few days, there was kind of some panic going on in every little bank, and people, and then the big banks, right, the mega cap banks were actually seeing people pulling their bank out of the small banks and putting it into the big banks. And so, options became, very, very busy in the financial sector in general. And the ability for somebody to use options to basically say, okay, now I'm concerned about this specific company. I want to buy some puts or do some sort of bearish strategy, but to kind of turn it into a pairs trade, and express their view. Options let them do anything they wanted. And then on top of that, you have all the financial ETFs, right? There's, banking ETF, but then there's also a regional banking ETF. So we saw people basically rotating capital to reflect their view and, doing it efficiently and being able to put on the kind of profile that they want. I mean, there's over the last really 20 years since options became very electronified in terms of trading, we've just seen continuous innovation. So it is kind of amazing to think that, we're 50 years into it. Cboe's 50 years old. Listed options are 50 years old. Black-Scholes model is 50 years old. When we look at the activity now, today's option volume looks like it's going to be around 68 million contracts. Third busiest day ever. Only the third day ever over 60 million. It's insane, the amount of activity that's taking place. This is happening with no issues of exchange halts or anything like that. The technology is letting this, like I said, we'll easily be over 11.5 billion contracts this year. But what we see is these markets could support double that, triple that without any real changes. So some of the interesting innovations that it's just incremental, like complex order activity, right? This is, spreads have been around as long as options. The complex order books that trade spreads electronically have evolved. Cboe just upgraded our complex order book to handle 100 leg spreads, which I've decided to call centipede spreads if one ever trades. But the reality is you can kind of do anything you want now. I would love to see the ability to do cross-product spreads. Okay, right now that's not possible because of the regulatory issues, but I think we'll get there, right? Everybody wants to trade everything, and the efficiency and the automation in the markets makes it possible. So to be able to kind of decide what you want to do, whether you're an institutional trader with a big book or whether you're a retail trader that knows something and knows the way they want to put their capital to work, to be able to do that precisely and say, okay, yeah, I want to do this against this, and I want to pay for it by doing this other strategy, and I want to push the button and it executes, and there's no risk of it not kind of executing the way you expect. That's the kind of innovation that I see that just kind of shows how well things are going in the business. I mean, the new trading floor is beautiful. It's interesting because I had dinner last night with some people that used to work as book officials on the old trading floor when there were book officials. And so, there aren't book officials anymore because the order book is purely electronic. I mean, people have been saying, do we really need a trading floor for years and years? Yet that especially for a product like SPX, where the average daily premium trade turning over in SPX is about $12 billion. So it is by far, it's about half of the U.S. listed option market dollars trade in that one single hit, and I think that's why it makes sense that that centralized pool of liquidity is massive, and it kind of needs to be to support the size trades that come through there. But what's interesting is you also, in the 0-day contracts, those trade almost purely electronic. So SPX is a hybrid product, but when you kind of slice and dice it, you see the 0 days are mostly trading in very small lots, a lot of retail activity, like I said. But the pit is kind of working seamlessly with them, right? The same participants are quoting these short-dated options, and then in open outcry, they're trading these longer-dated options. And in a way, that's also why we haven't really seen the longer-dated SPX volume drop off, while this shorter-dated volume has gone from 0 to 1.5 million. So it's kind of a different use case, it's a different style of trading, and they seem to kind of coexist harmoniously. So the trading floor where SPX and VIX are, it serves the purpose of these really big trades, which, I used to trade at a couple of different banks, and there's a lot of stress when you have a trade that is, billions of dollars in capital. You don't want anything to go wrong. And when you're going to put that into kind of a screen and trade against a screen, there's a little bit of like a moment where you're like, a heart flutter, right? You don't want to be what if you're on the wrong line? What if you're, there's a lot of that's been solved with kind of safeties that are built into the technology. But when you have a broker on the phone, and you're like, I need to buy 10,000 of these against, 280 combos at this price level, it's negotiated, it's careful, and there's not really any possibility of that getting screwed up because people are involved to kind of make sure it's all done the right way. And it's a different style from the automated execution we see for other types of trading. And what's cool is they'll just kind of work together. Oh man, I use ChatGPT almost every day for certain purposes. A lot of query development and Python code writing. I know, at least I've learned what not to use it for. AI, these tools make a lot of things possible and easier. Just things like, hey, you know what? I'm interested in selling a 90-day put in Apple, for $1. What strike would that be, right? You and I know how to look that up on a screen, but it's going to take you a few minutes. And something like AI can handle that query and not only get you the option and get you the indicative pricing, right? But you can also say, how would it look if I had sold that, every month for the last 2 years and rolled it when this certain situation happened and avoided earnings weeks? And so to me, AI is just a tool to make things a lot easier, a lot faster, kind of a lot more intuitive. And like I said, I use it for coding, and because then you don't really need to worry about, you forgot a semicolon, so it won't run. That AI doesn't forget the semicolon.